We are thinking about the markets right now, where we are in recovery. Certainly some strength in regionals giving us some confidence that, okay, perhaps the worst of the crisis is behind us. Let's bring in Eddy Gifford, wealth advisor at TACTIVE for the tech space for active investing. Eddy, thanks so much for being with us. Let's just start with how we answer that question. Do you think the worst is behind us? Yes. Last week certainly didn't feel that way.
Yeah, last week didn't feel that way. And it's hard to just think that, oh, well, the weekend's over and everything is rosy again, right? So we're definitely paying attention. We're definitely concerned in general about what could happen with the regionals, because those are really going to be the telltale sign of what happens over the next 6, 9, 12 months, is whether or not those regional banks can continue to climb out of the hole that they found themselves in. Of course, we had a few upgrades last week on the regional banks that were getting hit the hardest. The question is that really going to matter? So far, so good. We've seen them up almost over 100% in the last 3 days. I'm sure all of us wish we would have bought them, but last week, it just felt like we were at a tipping point, and I don't think that we're quite there yet, but I do think that we do have a little bit more of a footing underneath us. So we're cautiously optimistic. We're still being very, very selective in what we're doing. And anytime that we're buying anything, we're making sure we have a predetermined stop and profit targets associated with it.
So let's look at kind of this basket of areas that you're looking at: Nvidia, Meta, yep, home builders, and then gold and silver ETFs. Is there a common thread here? How do all of these names come under your umbrella for opportunities right now?
Well, anytime you start with anything, you got to think of, okay, how am I going to construct this portfolio, right? We want to make sure that we have some balance. And we're not huge fans of the old school 60-40, just because interest rates have been so volatile and the bond market has been more volatile than stocks and even commodities for that matter over the last 18 months. So that's kind of the first thing we're looking at, is how do we develop and build balance for our clients? And then the next thing is, okay, so where do we look? Well, one of the obvious, in my opinion, one of the obvious places to look is go to technology, right? So Nvidia, chip maker, semis, they're doing a lot of things on not only the PC and retail side, on the business side, the AI side of things. Yeah, AI is the big buzzword right now. So anyone who's developing the chips that can help support that long term, we think is a good opportunity. Meta, the Facebook, it's kind of like the old new thing. Facebook was obviously the thing 5, 6, 7 years ago. As business owners and as small business look to kind of try to battle out of this hole with them up against these higher interest rates and everything going on, they need to advertise somewhere. And Facebook seems to be the place to go for that, specifically more so probably Instagram right now. But that's why we think that there's upside potential there. And then on the other side of the coin, it's one of those things where it's okay, what about builders? What about real estate? Everyone keeps talking about how, we're heading for a recession, we're heading for a recession, we're heading for a recession. But at the end of the day, housing leads that. And as of right now, because of inventory issues, the builders are in a really, really good spot. A lot of people that maybe bought their home a couple years ago, they're sitting in a situation where they're kind of stuck, right? We have an interest rate, at least domestically in the US, we have an interest rate of 3%. And why would I sell my house and go get an interest rate of 7% over here? It doesn't make any sense, right? So where's the inventory going to be? Well, the inventory is going to be with the builders, with the new stuff that's coming out, not the people that are looking for resales. The other thing is people can cash flow their properties pretty easily if they were to leave. And so there's not a whole lot of reason to sell real estate right now. And so those are kind of the reasons that we're looking at builders in general, and then, technology.
Okay, let's unpack some of this. With Nvidia, obviously yes, it's the go-to name for AI. It's trading at 123 yes, times earnings. It's trading at 26 times sales.
Right.
It's completely, I don't even know if price for perfection is the right word. I feel like it's looking at perfection in the rear view mirror. I get that it's there and it could be there, but one little misstep, how much air comes out of this one?
Well, that's the issue. And I think that's the issue around the board right now. It doesn't matter what you're looking at. one little misstep, one break, and we could see 20 to 30% downside really, really quick. So that's where, if you're entering it, we're going to let our runners run, but at the same time, we're going to make sure that we have stops in place. And if we're buying Nvidia right now, we have a 15% stop set below the current price. And that's just like how we're doing it, because we don't want to let it run away on us and not get that. But we're also aware of the fact that we could have a debt crisis fight next month, or we could have regional banks turn around and fall again. And so there's a lot of little things that could happen that could get real big real quick. And so we're not afraid to invest, but at the same time, we're either dollar cost averaging in or we're putting those stops in place to protect our investors.
And is that where kind of your gold and silver play into your portfolios when you think about those downside risks?
Yes, absolutely. Gold and silver, like the one thing when we're looking at things historically is, hey, what time period is most similar to this? And I think that we would have to go to the 70s as kind of the most similar time frame. And if we look at the 70s to 1970 to 1980, the broad market was relatively flat over that time period, but we saw gold surge over 1,000% in that same time period. And so just because just in case we're on the edge or the cusp of some type of commodity super cycle, we want to make sure that we have gold and silver in that portfolio. Of course, we're still doing the same thing, though. We can be wrong there. So we want to make sure we have those stops and targets in place. But we feel like that gives us a better balance in an elevated interest rate environment to be able to at least create a more stable return. Of course, stable is a weird term in today's market because things are so volatile, but at least to kind of smooth out the ride a little bit.